Okay, good afternoon still, ladies and gentlemen. This session is entitled Absolute Assets, Accounting for Natural Capital in Risk Management. We've got a wonderful panel here this evening to talk through this subject. First, we're going to have an introductory talk by Dr. Pavan Sukhdev, and then we will have a panel discussion. Why are we talking about this subject? Well, clearly there is mounting evidence that the current loss of natural capital is far exceeding the economic losses of the 2008 financial crisis. And what we're trying to do in this session is to provide some insight into how financial institutions are beginning to think about the concept of natural capital and ecosystem services. Pavan, perhaps I'd ask you to take the stage now and make your introductory remarks. Thank you.
Thanks. Good afternoon, everyone. Delighted to be here with you today. These days after the TEEB, how many people are familiar or have heard of the TEEB project? Quite a number. Okay, so I'm in the aftermath of TEEB right now because it's become a project which is on natural capital, which is about ecosystem services, and it's gradually being implemented by several countries, especially Brazil has taken this forward quite aggressively, both at the state level in a few states and the business level, India, Germany, Norway, the Netherlands, and many others. And I think businesses are actually taking a lot of interest, especially a coalition formed in the UK, which is accounting for externalities. And I'll explain why I mentioned this in a moment. But my life today is to try and bring these ideas back to economics. And I'm trying to do that at Yale University, which they have very kindly let me hold a graduate course on TEEB. So these days I'm wearing the unusual and first time ever hat of a professor. And I've never done that before. So it's quite scary, actually. It's a lot harder work, let me tell you, than I ever imagined it would be. I thought it would be just a breeze, just land up and talk. But you can't just do that. So today I want to talk to you and introduce the topic, really, about the role of risk management in banks, and within that, the role of natural capital. And let me go back and set the context as to why this is a space which, one way or the other, we will have to start focusing on. Well, firstly, the context today is that we are seeing a huge backlash against free market capitalism. I don't think you need to be reminded of the Occupy Wall Street. And in fact, just last weekend, there was a group congregated on the steps of St. Paul's in the City of London. So clearly there is a sense of frustration with the system that we have today. And this frustration is not new, because if we go back a few months, there were riots in London. And that's unusual. London is a very civilized, well-policed kind of urban environment, and one where community tensions are there, but they tend to be well managed. But this time, the riots were somewhat different. It wasn't any particular race or community that was rioting. It was the youth. They were unemployed. And when rioting, of course, they smashed shops and windows. But just read up what exactly they took from there. They took branded goods. They didn't take television sets unless they were branded. They took pullovers and jerseys and clothes, and basically they were going for consumerism. And the problem is they had no cash. So to me, the London riots represented the ultimate consumerism without cash. Walk in, take what you want. And that again is backlash. So we have a backlash on consumerism. We clearly have a backlash against free market capitalism. And I remain a capitalist, but I call myself a total capitalist because I believe in three forms of capital: human capital, natural capital, and financial capital. And I think that any system of agency at a corporate level or any system of agency at a government level which does not recognize all three just needs to have its head examined, because that can't survive. That is not a solution for sustainable life on this planet. So in the context of the backlash that we're talking about, how well have we done as a financial community? And to those of you who don't know, I've been a banker for most of my life. It's only at the fag end that I'm sort of out of banking. And in fact, I've been working on environmental economics for 13 out of my 28 years in finance, and parallel processing both the environmental side and my banking work. It's only recently with the TEEB project and the Green Economy Report that I became fully dedicated to this. But how well have we done? So let me narrate at least the 3 crises that I have lived through and worked through, starting with the savings and loans crisis here, and then going on to the Asian debt crisis, which was my life for a couple of years, and then, of course, which was everybody's life, which is the CDO crisis, which was more recent. And in each of these crises, and before that, the Latin American debt crisis, and in each of these crises, we see how we haven't, as a community, recognized leverage and recognized significant amounts of increase in leverage in some sector or the other, whether it's countries borrowing in the case of the Latin American debt crisis, or the SNLs borrowing in the case of the savings and loan crisis here in the US, or companies borrowing for all kinds of bizarre reasons, including speculation and including trying to get away with cheap dollars as an alternative to pegged local currencies in Asia. In the Asian debt crisis, or most recently, of course, subprime borrowers, which basically means people who don't have a snowball's hope in hell of repaying you, borrowing in order to improve their homes or to buy new homes. In each case, there is leverage. In each case, we, the financial community, instead of controlling it, appear to have allowed it to balloon and escalate. And that raises the question as to what kind of risks do we manage? And my experience as a financial markets person is that we manage markets risks really well. We manage credit risk reasonably well. We calculate to an extent, and you can therefore say we manage event risk to an extent. But the risks that we don't seem to manage particularly well are systemic risks. So we can say that I think at the level of systemic risk, our anticipation has not been that good, to a point where when we're talking about excessive leverage or ballooning in leverage, which is the ultimate driver of all of these 4 crises in finance, we've not really been able to get a handle on them until it's too late. There is, unfortunately, a trend out here, and when I say systemic risk, I have to look beyond systemic risk related to leverage, but also what about systemic risk related to regulations changing, or what the textbooks describe as regulatory risk. And for those who have definitional issues, regulatory risk is not about the risk of breaking rules. It's the risk of regulations changing and therefore negatively impacting your profit and loss. We are not very good at managing that. So a history of 4 crises over the last 30-odd years, a history of bailouts, and a history of risks at a systemic level not really being anticipated well or managed well. And I think we are facing, in my opinion, another round of systemic risk here. And this relates to this thing called externalities. Why do I say this? A few studies have been done recently, including one by TrueCost, which is quite comprehensive, which have estimated the externalities of corporations. And by that I mean the cost to society of doing business as usual. In other words, the cost to society of climate change as a result of emissions, or the cost to society and communities of freshwater extraction at non-market prices, or the cost to society of biodiversity losses or ecosystem service flow losses. Add all these up, and for the top 3,000 listed corporations, a result that stunned me was that the total amount of externalities were about $2.15 trillion US. And that's in a year. That means it's about 3.5% of GDP, global GDP. If we take into account all private sector corporations, the total externalities were $4 trillion. So what this really means is that we have effectively a $4 trillion free lunch taking place, where corporations are busy internalizing profits and booking profits, and we as bankers are busy lending to them and exposing ourselves to them in terms of contracts and derivatives tickets. But we are not recognizing what's happening in the parallel universe of externalized costs. Another related calculation that was done was that if these externalized costs, through regulatory risk, in other words, the risks of regulations getting more stringent and forcing companies to reflect their emissions costs, for instance, or reflect their other environmental costs, then the amount that they would have to reflect is about half their total profit and loss. That's on average. And you can imagine that many companies for whom the externalities would be much bigger than their profit and loss. So what this means is that once again, we are at a point where we are not recognizing that systemically, companies who are quote-unquote profitable may not actually be profitable in the long run. And we are not factoring that in. Of course, we are careful at the transaction level whether we do a derivative and we take the credit spread and we build that in and we keep sufficient capital, hopefully provision it and so on. We do those things well. Transactionally, we are fine. And even in terms of event risk, maybe we calculate well. But once again, at a systemic risk level, we're just not factoring this in. And the question is, can we keep doing that? And my point is that no, because if anything is to be learned from the last 4 crises, it is that the risks of unlimited leverage or the risks of leverage at the client end not being managed by us, and of course you can argue as to whether it's our job to manage it or the regulator's job to manage it, but the point is it's not managed. We are the coal face, we are the ones taking the exposure and the risk. How are we addressing the systemic aspects of that? So once again, as with leverage generating the crises of the past, I anticipate that there is another crisis coming, which this time will be generated by externalities finally hitting the bottom lines of the corporations to whom we are just happily lending away money, exposing to derivatives contracts, and basically piling up exposures without recognizing the potential costs of doing so. Credit spreads can explode. And those who are, how many people from markets out here? Not that many, but I can tell you, but those who are will understand what I mean, that credit spreads can explode. And you can keep thinking about hedging and so on, but the reality is that when the cookie crumbles, it just flattens out. And you do not have the time or the ability to book the kind of losses that spread explosion would entail. So where do we go from here? Now, recognizing externalities is something that will need to be done, and these externalities, as it happens, most of them today happen to be in the space of natural capital. What are we talking about? Emissions and the quantified cost of emissions, freshwater extraction and the cost of that. How much can this be? Well, I've given you the numbers for the overall context, which have been done by a company, but recently Puma came out with a calculation of their own. Puma's part of the PPR group now, but they are a company which has, I think last reported P&L was $300 million, and after depreciation and so on, $200 million. Their calculated externalities were of the order of $45 to $50 million each for the carbon emission side and the freshwater side. And of course, most of these externalities, these costs of doing business, were actually up the supply chain, down the supply chain, I should say, because they were raw material suppliers, i.e. the water used by cotton growers, or for that matter, the emissions at the base of the pyramid of their supply chain. But that it is important to quantify these, and it's important to recognize what would the P&L look like of a company such as Puma, otherwise very well, performing well. Well, it wouldn't look all that hot. And that's really the challenge. How do we anticipate that kind of systemic issue? So today we have a situation where the ability to make these calculations has increased. The TEEB project has brought to the table a lot of expertise and pulled together and provided some degree of standardization of approach, if not of methodology as of now. And the chances are that accountancy bodies around the world, and some of them are looking at this today, including the UK, they will realize that it is in the interest of the public that some form of disclosure needs to take place. And where there is public disclosure, before there is public disclosure, we as bankers, we as the main counterparts who are taking on this risk have to be prepared. Capital backing might have to be provided. Today, there is sufficient capital backing based on sometimes our own calculations, which people can question, and sometimes based on regulatory calculations. We have capital backing for market price risk and credit risk and operational risk and so on. We do calculate VAR, value at risk, for our own trading portfolios. If we are on the investment side and we calculate Sharpe ratios and we work things out in terms of risk and return, and that's all great. But have we ever bothered to calculate, for example, ecological VAR, the value at risk as a result of ecological crises? In other words, agricultural companies suffering a cost to its performance due to freshwater shortage, or for that matter, an oil company drilling in the Gulf of Mexico suffering a huge hit to its bottom line and a loss in its market value to the extent of $20-odd billion, because it happened to have been carrying an ecological VAR at that time of something like $50 billion or $55 billion, according to some calculations. Nobody ever calculated that. And my final point is, imagine if in April 2010, before that catastrophe happened and before shareholders lost money and before the company had to book provisions, imagine if there were an ecological VAR calculations. How different might that have been? Would they have balked, for instance, at investing in additional technology to protect the leakage, sound-based leakage of control of oil? Or would credit spreads in the marketplace have reflected that? And to what extent would credit spreads have blown after the event as against before the event is still an open question. But the fact is, it would have been a very different world. And I fear that we are not being honest to ourselves when we ignore this. Because even value at risk, VAR, is really only about 25 years old. It's a technology that came in when it was realized that market movements were quite dramatic and that capital in banks was exposed to market movements, and you needed some slightly more advanced methodology to capture that. Today we realize that ecological value at risk is real. We've seen a huge example of that less than a year and a half ago. Why are we not taking the next steps to start calculating that, to start creating the metrics, a bit like, say, J.P.Morgan created risk metrics long years ago? And I think these are the issues that I want to leave with. So, in summary, we have a context which is something that causes us concern. We have a history where we haven't managed crises particularly well, and the reason for that is our ability to manage risk at the transaction level, sometimes at the event level, but not often at the systemic level. We are seeing our customers, corporations, indulge in a free lunch, and that free lunch is that of externalities. And if there's one thing I can tell you about a free lunch, it can be tasty, it can be great, someone always pays for it, but you cannot have free lunches again and again for very long. No free lunch ever lasted a lifetime. Thank you very much.
Thank you. Now, before we move on to the panel session, are there any questions of clarification for Pavan? Absolutely crystal clear. Now, there's a lot of, obviously crystal clear from that reaction. We were talking earlier, there's a lot of misunderstanding. People throw around terms like biodiversity and ecosystems, ecosystem services and natural capital, and often use them interchangeably. But from your economics perspective, you would see natural capital as the NPV of ecosystem services.
Absolutely.
After the application of an appropriate
discount rates. Yeah. Natural capital is the stock.
Yeah.
And all that it is basically just the summation of future ecosystem service flows from any particular biome or any particular group of natural assets.
Okay.
And that present value is discounted at some discount rate.
Yes.
And that is your natural capital. So ecosystem services and natural capital are really flow and stock, and they are the same thing in that sense.
Okay, well now we'll have some brief comments from the panel, and then we'll enter into a hopefully an interactive discussion with you. I'd like to introduce Loriana Conzo of IFC, who can give some insight into the IFC experience in approaching the issue of ecosystem services.
Absolutely. We've recently tried to take this on. We have taken this on as part of our performance standard review and update process. So as most of you, well, I guess some of you might know that we just went through a 2-year update and review of our 8 performance standards. One is biodiversity and now living natural resources. As part of this review process, it came out quite strongly that ecosystem services needed more attention. And it has received more attention. So IFC has taken the lead, I think, amongst the IFIs in trying to operationalize this approach in mainstream it within its performance standard. It's housed in the biodiversity standard, and it's mainstreamed in a number of others: community health and safety, indigenous peoples, land acquisition, and cultural heritage. So quite a number. In short, how we deal with this is we ask companies to systematically identify and assess and prioritize ecosystem services. We then ask them to avoid priority ecosystem services. If that's not possible, we ask them to define mitigation measures that aim to maintain the value and functionality of the service. And what's interesting here is we define ecosystem services in 2 ways. One is services used by local communities. So traditionally, projects would be looking, or companies would be looking at how they impact on services that are of use of local communities, i.e. benefits, ecosystem services benefits. But the new piece, at least amongst private sector policy, it's not new amongst TEEB and other initiatives, but the new piece for our policy is really asking companies to also value services on which they depend for their operations. So that's slightly different. The requirements in PS are slightly different for these two types of ecosystem services, but they're both integrated into the policy.
Okay, thank you, Laurie. We'll now move on to André Abadie, who's recently joined J.P.Morgan Chase as a managing director, managing environmental risk. André, your perspectives from that new seat.
Well, I'll give a perspective from not only from J.P.Morgan, but spending 4.5 years consulting to banks in this space. And I think it's fair to say that most banks still talk about biodiversity. It's very much what are the risks to biodiversity. Very few banks have gotten to the stage where we're talking about natural capital or ecosystem services yet. I think the introduction of ecosystem services into the performance standards is going to certainly help from an Equator Principles perspective. But the key thing to remember is that clearly what banks are trying to do is make more informed decisions, taking these factors into account. And where we see that most pointedly and most easily definable is at a project or an asset level, which is where the Equator Principles and the performance standards are applied. It becomes increasingly difficult when you go away from a specific asset or project to a corporate loan or even considering ecosystem services impacts at a portfolio level. Banks just aren't yet at that stage where they're taking this into account. It doesn't mean we shouldn't get there. And this certainly is one of the things that within J.P.Morgan we are going to start looking at more pointedly. So I think the key is we are open and certainly are very eager to understand more about what TEEB is doing, start looking at where the IFC is taking the performance standards. And I do agree that there is ultimately natural capital value at risk here. We've heard Al Gore talk about the fact that banks may wake up overnight and suddenly find that there are subprime carbon assets. And there may in time also be a situation where if you take natural capital into account, indeed you also have a situation where there is going to be natural capital value at risk, which banks should be taking into consideration.
Thanks, André. Shawn Miller of Citigroup. You've been heavily involved with the Equator Principles and its development. How does Citi see this issue?
Well, actually, I'm similar to André. I'm glad that we actually have a professor here because I learned a lot from his introduction. And obviously, Laurie is a real specialist, and we draw upon her and IFC's expertise. I mean, I see this as a real challenge for us in the finance sector. It is a concept that is kind of hard to get your head around. And I think, obviously, there's been a great evolution starting with the World Bank's original safeguard policies back in the 80s, with the evolution of that, the IFC taking into account the safeguard policy in 1998, and then that evolution to the performance standard. Then with the commercial banks obviously coming in using the Equator Principles, incorporating obviously a whole set of risks, including biodiversity. It's a very interesting journey that we've been on. One thing, just in terms of kind of where we are now and where are we going, in January of 2010, the SEC mandated disclosure of climate change information that could have, quote, material financial impacts to companies. And it's interesting, are disclosure requirements for water risks on the horizon? Those types of issues. So as banks, we better start to get our head around these challenging issues, because actually our regulators and others are starting to look at them and take them into account. Kind of where are we going from my perspective? Again, as I said, from an Equator perspective, I do think that this is an issue that we're going to have a lot of challenges on. There's going to be major capacity building issues and challenges, training. We're going to have to partner with organizations such as TEEB and others, UNEP FI and others, IFC, to be able to take us on that journey. According to a survey by PwC in 2009, 27% of global CEOs expressed concern about the impacts of biodiversity loss and their business growth prospects. So it's on the agenda, it's on the radar screen of everybody, but I think we're still trying to figure it out. So thank you for asking us to come and speak about it.
Yeah, it's really interesting. I mean, the World Economic Forum also does a sort of annual survey of what are CEOs worrying about, and you saw a lot of manifestations of natural capital-related risks around water, biodiversity, climate change, etc. And they are moving in terms of their perceived likelihood of occurrence and also perceived value at risk. We're now going to have a different perspective. Daniela Mariuzzo is from Rabobank in Brazil. Therefore interesting from two perspectives, because Rabobank is a bank for whom agriculture is a core business and part of its heritage, and she comes from Brazil, which must be considered to be on at least one of the front lines of this particular issue. So Daniela, over to you.
Thank you. So I'll try to keep it very short, and I took the chance to show something to our audience and our colleagues here. That's the way Rabobank, in a level, the group level and also Brazilian level, is considering sustainability nowadays. So the point is that we are financing all the parts of the supply chain. And 5 or 7, 8 years ago, there was a clear message from our stakeholders to identify the risks of this financing process and to manage the risks. So the process started 6 years ago, defining the risks, for instance, to finance farmers in Brazil and to finance input providers and processing companies and traders. And we found out a lot of issues, and then we started with a CSR policy that's local interpreted. And when we started that, we saw that there were farmers that couldn't be financed by Rabobank if we don't engage it. So we asked these farmers, yes, you're not at this moment qualified to be a client from Rabobank, but we want you to improve. And when we say that, we are not excluding people, but because we don't need more excluded persons and companies in the world, but we are engaged to find solutions together. So if I get the example of forestries, in our CSR policy, we are saying that we don't want to have a relationship with clients that are cutting trees illegally in Brazil. So there is a guy that want to be client from Rabobank, and he said, I had this mistake, I will not behave like this no more, I reforest the area I cut. So what we say, okay, so if you reforest, then we are going to lend you money. But this, on the other hand, is also bringing for us opportunities, because once the guy is planting trees back, he's generating carbon credits. So if we asking for an input provider, that's our client, a big multinational company, to follow our policy, that means this company will also ask to the buyer of the inputs to follow the policy. So the power is bigger when we finance the big companies, because we can say also for a buyer or a trader, you should buy only for farmers, from farmers that are doing that in that correct way, or to help them to improve. But managing the risk also means for us that we have opportunities. So there is I don't have crystal balls, yes. Of course. Yeah. But the point is that for the next 5 years, the message is really clear for us. We have to look to find out the opportunities, the new business models, because the kind of challenges our humanity is facing at this moment, there are no answers, red answers. So what we see is that maybe this financial product can help, but it's not correct. We should do something, or maybe we should create a new thing that doesn't exist. So the answers are not red, and the idea for Rabobank is to bring the concepts from the supply chain and to work with that, and we're doing that in 2 regions in Brazil. And we think we are succeeding with, for instance, with meat processors, soy processors, and all these commodity traders, everything. So we are trying to give here also a message that we saw the last 10 years managing the risk is nice, it's important, and it's needed. But once you manage it, you should move further and go for the opportunity. So this is a clear message I want to give to you. And just the final, but very important, is that we have a partnership with WWF, a global partnership. And the concept that they are using for market transformation, I'm sorry I'm not looking to you because my microphone is here, okay? So the concept is that it's difficult to engage with more than 1 billion producers. It's almost impossible. And it's also difficult to convince more than 6 billion shoppers to buy the certified products. But it's much more easier to talk with the supply chain and with the companies that have the power to buy the products from the producers and to sell it. So if we're talking about financiers, investors, and insurance companies, if we think we could go to talk to the companies, for instance, traders, because 50% of these companies, these traders' companies, is controlled by 100 companies only. So if we go to these companies, it's more powerful to achieve the sustainability to supply chain. So this is the point of leverage to us to work together. So this is more or less the message in a very short way to say, but we can talk later.
Okay, thank you. I'm interested in a lot of clients, corporates are looking at this issue through the lens of their supply chain. It seems to be one of the direct ways in which they're being confronted by this. I mean, we're seeing particularly some of the large food companies like Unilever looking to continue with their expansion, but severely reduce their footprint as a business. We're also seeing this proliferation of certification standards growing up across the sort of biodiversity and ecosystem space. I mean, what role is certification helpful for financiers? Any thoughts or comments?
Sure, and I'll pick up on the last point Shawn was making, that we need to be more aware of where regulation is going. And I think certification also is in a similar way giving us better insights into how companies are performing, how they're understanding and analyzing risks within their supply chain or their actual operations. And all of that gives us better insights into the client's business. I mean, let's face it, banking is, I've always said, is pretty simple. It's about two things. It's about understanding risk and understanding your client's business. And the more insights we can get into our client's business, the more informed our decision-making will be. Now, certification, in a lot of senses, is still very much voluntary and isn't yet getting to the point where it is putting too much of a price on issues. But I do think that as we move into regulation, as we are seeing a number of voluntary initiatives and certifications, it's coming down to a more pointed view on what the issues are, how these externalities are being considered. Can we eventually get to the point where we're actually seeing price being attached to some of these factors as well? And that is fundamental. We talk about new business models, and we talk about the fact that there's value at risk. And fundamentally, the reason we're all looking at this is where is there value at risk in the future? Can we start future-proofing our portfolios? How do we start reallocating capital? And regulation, certification, certainly are markers which are going to give us more insights into where it is capital should be flowing.
Metrics is one of the big issues there. I mean, Pavan, from your perspective, how big are the gaps in metrics to help us really understand this?
Sadly, they're still quite large, and this is not just a bank or a financial industry issue, it's also a national issue. Yeah. So natural capital is not really recognized in the national accounting systems, but that is hopefully going to start getting corrected as the WAVES project. It's a World Bank-sponsored project on wealth accounting and valuation of ecosystem services. Yeah. About 6 or 7 developing nations interested and a few developed. So hopefully at the national level, there'll be a better appreciation of what is natural capital and how is it declining in most cases, and is that rate of decline dangerous, and if so, how, and what its impacts are on the poor, because that's where the biggest impacts are. Then, so that's at the national scale. And then at the corporate scale, I think what we are talking about here is the need for corporations to start, at least for their own management, never mind whether it's for the public, but at least for themselves, understand what are their dependencies on nature, what do they get free, and how likely is it to be not available in future, and secondly, to understand their footprints on the environment, their footprints especially on ecosystems, and therefore their ecological footprint, because potentially that footprint has a cost outside, which could become inside, and therefore what was an economic cost to the community will become a financial cost to the shareholder. And that flip can happen very suddenly. And the risk of the flip is really what you need to sort of anticipate and manage.
But I think going back to a point that André made in terms of projects, corporate loans, et cetera, the challenge I think that we as banks and financiers on this issue is that we are, again, one step removed. We're an advisor to our clients, correct? So unless we're putting our capital at risk in some sort of asset, et cetera, really, I think we need to learn to be better advisors to our clients as to, how these issues can potentially affect them, affect their share price, affect their reputation, et cetera.
It's interesting. If I may sort of not to disagree, but also to add an aspect that yes, we have an important advisory role, and we are one stage removed, but that remove is basically through exposure, and we do have credit exposure. And the question is, are we pricing that credit exposure correctly? And that's not just for loans. After all, derivatives contracts also have to have correctly priced spreads into the derivatives.
So we need those methodologies.
We need those methodologies, and we need to sort of recognize that today the pricing of everything is pretty much wrong.
Right.
And that can't be
It's interesting that you talked about national accounts. I mean, yesterday we launched a UNEP FI project on looking at the concept of natural capital in sovereign credit ratings, and can we bring ecological footprinting into sovereign credit ratings, and we're working with the Global Footprint Network on that. And it seems to me to be a very powerful place to start, because if you can force that understanding at government level, it's far more likely to promote the sort of regulation.
Exactly. Psychologically, it'll be a lot easier to push it down to the finance and corporate level.
But tomorrow evening, if anybody's interested, the Natural Value Initiative are also producing or launching a report, I think it's 6:30 after the end of this conference, looking at the extractive industry, and they've been looking at this issue between natural capital and financial value.
Yes.
And it is a very thorny, complex issue. Maybe we can open this out to the audience now. Maybe we can have the lights up a little so we can actually see the audience. That's brilliant. Great. There's the question down here. If you could give your name before you ask your question, and we have some roving microphones. Excellent.
Giorgio Capurri from UniCredit. So the question is for Pavan. Addressing the problem of natural capital in terms of NPV is fascinating, definitely. I think that is linked also to the remark that you made on the fact that we cannot measure the systemic risk.
Yeah.
The reason why we cannot assess the systemic risk because we are inside the system. And this system is based on economic standards of the science of economics, which tells us that whatever is not is always available is not priced. And this is not true any longer. It is clear for everyone. But we lack the measure. And the reason why we lack the measure, in my opinion, is that we cannot assess correctly which are the services. Because if we have to discount 20 years ahead of services in net present value, whatever the rate of discount is, we really need to understand, at least on a yearly basis, which is the amount of service that ecosystem provides. I remember last year I was in a conference on the World Soil Day, and the academic world on that was completely naive. They didn't really even think about the possibility to have a measurement of how much we can value the service of a square meter of soil. Besides, we lack also a concrete knowledge of the biodiversity which is inside, because when we assess the biodiversity measures, we talk about medium to large size animals and not the entire population. So the question to you is an academic. How far can we go in assessing this kind of measurement? And if this is really possible, because as a banker, I'm not in risk management, but I deal with them on a daily basis. And the real question is, it is very nice what you say, but we are ready to address the topic that you are raising on a qualitative way. But if you want us to understand how we can put that into a function, in production function, and understanding the value at risk that we have in terms of natural capital, we need a metrics, and that metric should be provided probably from the academic world. Where are we on that?
Well, certainly a lot better than we were 5 years ago. I think this is an evolving space. So today, as I mentioned, I'm, by the way, not a professor historically. It's just something that I'm doing these days, is to teach the TEEB technologies and the TEEB methods at Yale University.
You retired from banking?
Yeah, basically.
That's good.
That's right. No, but the thing is, it comes up when you converse with students, and they're bright students. It comes up to what extent all of these methodologies have their own limitations. But having said that, we have another dimension. In addition to not understanding ecosystem functionality enough to value it properly, and in terms of not understanding thresholds to ecosystems and what happens as you approach thresholds is far from linear. In addition to that, there's another dimension to this, which is public wealth versus private wealth. Because most of our thinking and most of our economics is so targeted at market-based mechanisms and market-based universes that the moment you move away from markets and private ownership, the whole thing just crumbles. So you need to address that in sometimes psychologically at a very fundamental level to say that, hang on, you can't own this. I'm not going to buy natural capital from you or sell it to you. The fact is there is natural capital. In this particular case, it happens to be publicly owned. If it's global atmospheric commons, by the whole earth. If it's forest, then it's by the country. If it's whatever local water supply, then by the local community. There are different levels of ownership. There are different scales of ownership, and if you like, if you want to call it ownership, and that's very much a Judeo-Christian concept, because you could argue it's not owned by anyone. So there are all these issues there in terms of public versus private, nature as something within which we are part of, or nature as something for which we take custody, the actual understanding of the ecosystem, applying economic values to that ecosystem, whether we can actually think and jump to any market conclusion in most cases. And I'll give you from the TEEB reports themselves. TEEB's got several reports, and one of those addresses policy implications, policy applications on the ground. We have something like 115 case studies there. About half of those are payments for ecosystem services. Another 20, 25 are basically land use change planning decisions, and another are to do with legislations and so on. These are all 115 examples of non-market solutions. They all use economics to make the case, but not one of them is a market solution out of this entire set. There are, of course, market solutions, biodiversity markets and wetland banking markets here in the US and so on. But markets are not the answer to everything, and the number of times I have to remind even economists that this is not what we are talking about is not funny. And these are bright economists. Some of them are PhD students, so they're sort of going on this track. You have to bring them back again and talk about, hang on, no markets here, can't have them. So there are all these issues which I think, at least now I can say with confidence that they are there. These issues are in the open, and people accept that they are real issues. And they don't sort of, they're not in the ignoring you phase. They're sort of not even in the laughing at you phase. They're kind of in the fighting you phase. That's a good sign. Because first they will ignore you, then they will laugh at you, then they'll fight, and then you win after that. So.
It seems to me there's one sort of process which is intellectualizing natural capital as a concept, and then for the people sort of at the coalface, it's how do you operationalize?
Yeah. Operationalization is actually happening as well, because when you come down to, okay, this community has a watershed and its value is X, and for instance in Beijing, the upstream farmers' actual actions on the use of fertilizers and pesticides is changed thanks to a payment provided by the Beijing municipality to them. A wetland in Kampala gets valued for sewage treatment services, and then a decision is reversed to convert it into more agricultural land. So actually on the ground, you get more tangible, real stuff. It's that in-between space between what's needed at the community level and how do you aggregate this at the province level and, God forbid, how at the state or country level. That's when it gets very, very complicated, and there's a lot of debate on that.
That must be an issue for you in the Brazilian context.
Yes. I was here wondering what kind of message I could pass to my colleagues here. And I think one of them is that everybody in the world can eat beef. So the point is that it's not fair if I say from now some 2 billion of people will not be able to eat beef because we cannot produce more beef, because it's not sustainable. So I think if we could find other difficult solutions for our questions, to find a sustainable beef is not impossible, and there is an enormous amount of research and possibilities to bring the reality to sustainability of the beef. So I think things like that we should try to avoid to say that 90 billion people is not sustainable. We cannot afford enough food for them, so they should not eat beef. It's too much to listen nowadays, so we are excluding again. So the idea is to analyze again the supply chain. The meat processors are committed to improve the situation of the farmers, and if this is the role for Rabobank, bring financial solutions for these meat processors to pay or to bring money to keep the trees there. So this is red. So this is the way we can keep the trees, and the guy doesn't need to cut more trees to produce beef. So it's not red, and it's difficult. It's really difficult. But I think even if we have very nice tools and metrics to measure what's going on, the most difficult thing is to have the engagement of all the parts of the chain. So this is what we are trying to do through the roundtables on sustainable commodities. So we are talking about palm oil and soy and cattle and sugar, because in these roundtables we have all the stakeholders. So we used to say it's a multi-stakeholder initiative, and we have the chance to listen to all the demands from all these parts. And then, what is important? If we have all the connections, then we can test the products, the metrics, and the methodologies. Because if you are just producing the methodologies and metrics, and we don't have where to test it in the supply chain, it's difficult to achieve, to know if this will work. So this is the idea. And then that's the reason I'm very glad with the declaration, the natural capital declaration, because it considers the supply chain idea and the scope. So that's important as well. I think it's a nice...
Yes, I don't know whether all of you are aware of the Natural Capital Declaration, but I mean, one of the UNEP FI initiatives that emanates from the Biodiversity and Ecosystem workstream is to try to socialize, and we're beginning to socialize the concept of a natural capital declaration by our members that will basically be presented in Rio. We're working on a draft. That draft is a short number of weeks away from being more or less a final draft, and we're very keen to get support of UNEP FI members, of PRI members to that declaration, and we will be engaging with you over the coming weeks and months to do that, because it's part of this challenge. Well, I don't know how you feel about it, Shawn, but I mean, how do we?
I'm coughing. That's how I feel.
How do you feel about it?
Apologies.
You know, how do we improve knowledge and understanding within the finance sector of the scale of this particular challenge, and in a world where the metrics don't actually help us to understand the financial impact of that? And what role can
Well, no, I
play?
think that actually, sorry for coughing so much, I think this is actually a great opportunity. I do think that the finance sector and banks can have a huge impact. We can influence, and we've seen that on a variety of issues. We've seen it on Equator. We've seen it on climate. We're trying to figure that out still. But just sending a signal that these are issues that are important to us as business, they're important to our clients, that that our clients need to integrate and value these issues. I think just sending that signal as a financial sector and as investors, it's a great opportunity for us.
Yeah. And we will be picking up on the work of the World Bank's WAVES project as part of that, because I think the accounting for this is core to its understanding. There must be more questions out there. There are some questions.
Question in front here.
There are a couple over there. 3, in fact.
First. Max Horst, climate neutral investments. We calculate greenhouse gas emissions of equity portfolios and then enable investors to offset that. Meaning we do price in externalities based on the costs, what it costs to reduce 1 ton of carbon today. And I was wondering, you said about market-based mechanisms that is not the solution. What I find interesting is in the carbon markets, and of course, there are compliance schemes in Europe, so large corporations, utilities, pulp and paper, cement, and so on, are subject to those. All of a sudden, have to disclose on the installation level what their carbon emissions are. So is that a way forward for other natural resources as well? The US is now establishing a compliance market, hopefully on the West Coast and on the East Coast. Is that a way to at least get to a level of disclosure from your point of view? Do you think these mechanisms have worked? Do you think we can draw conclusions from those for other things?
Sorry, presumably me?
I think that one's got your name on it, yes.
No, to be fair to you, it's not that there are no market solutions for certain aspects of the problem, but neither is it the case that only market solutions will provide all solutions to the problem. And because the problem is too vast, it's about decision-making at the national level, it's about decision-making at a provincial level, community level, business level, individual consumption level. You cannot have something as complex a problem as that, which is being driven by the economic invisibility of nature, and all these decisions at all of these stages, and the metrics to help make those decisions, all being wrong. All being wrong because there's some huge factor called natural capital, which is completely missing from any of these decisions. So that's the reason why solving it is not that straight. Now, secondly is the issue that, okay, in some cases you can just recognize the reality that, yes, certain places have a particular emotive appeal to communities. There are sacred forests in some parts of the world. There are other landscapes, Yosemite National Park or the Lake District, which are conserved because of a certain sort of societal preference to conserve them. And there are others where you find changes are being made to land use because, yes, we know that those particular forest areas do provide freshwater retention and cycling functions and soil enhancement functions, and therefore it's worth keeping them because it adds to soil fertility downstream, which adds to agricultural yield. You can measure it on a production function basis, et cetera, et cetera. So you know this, and therefore you decide, but you may or may not have done the calculation. So sometimes just the sheer recognition of value helps. Sometimes the demonstration of economic value is useful. Sometimes you can capture that value in the form of mechanisms like payments for ecosystem services. And there are many, many examples. There are literally dozens of examples already of good PES schemes. And then finally, there are some examples where you can create markets, as in a marketplace where there is some degree of ownership in some form. Even in the case of carbon markets, it's kind of it's like a global public bad, which the European Union, in its wisdom, has converted to a private good, and it's the absence of carbon, and then you cap it. And of course, there are issues there because different issues, too much issuance, basically. It's like money supply. And central banks issuing too much money causes inflation. Price of the asset drops, and that's what you've seen happening. But anyway, that's a separate issue. It was, I'm saying, a good experiment. We can argue afterwards with why I use the past tense. But the point is it proved a point that you can do this, but it's hugely complicated. So the market solution is not either the easiest solution nor the comprehensive solution, but it's part of a suite of solutions which address everything from norms and policies at the one end to market incentives and subsidies and taxes on the other, to payments for ecosystem services on the other, certification issues at the business level, and then finally a few market-based solutions. Frankly, this problem of the economic invisibility of nature is so deep, so extensive, and affects so many levels of human decision-making that there is just no single solution that's going to address all of it. And frankly, you need the entire armory of solutions that I have just mentioned, amongst which, of course, is your solution, which is ensure that at least investors have the ability to offset their, if you like, their portfolio externalities, if you want to call it that, and provide the means of that. And, you know, I mean, if your selection of your companies is good and you have well-managed companies in there, chances are that the performance of that portfolio is pretty good because it's been managing itself. It's typified. Good management is good at all management, so it's not just in pockets.
There were another couple of questions over there too.
Is this on? It's on. Christopher Herman with the Environmental Protection Agency. Just to pick up on that last intervention, I do have a difficulty, maybe others have gone past this already, with discussing natural capital. It appeared exclusively in terms of service, net present value of service flows.
Yeah.
And maybe that wasn't implied, but it does sound like we have to be very careful, and maybe some more work along the lines you were just describing of differentiating the breaking the problem down. Some forms of natural capital you would not necessarily want to state in monetized terms or imply a commodification or a marketization, or some you might. And working out that set of problems would, I think, be very helpful in sorting through some of these complications. I was a little concerned just to ask a question. It sounded like the IFC's definition of ecological services was oriented to the services provided to two communities, the affected communities in the first place and the corporation in the second. I wonder if that might not undercount the services provided to other communities, such as the biological communities.
Right. I can answer that. It's a different concept. I mean, we have 75% of the performance standard is focused on biodiversity conservation. So there, under those requirements, is where we would cover more general protection of ecological structure, processes, the language that we use, right? Everyone uses different language, but the language that we use is habitats. But under there is where we had to separate out these concepts. Don't forget here, IFC, we have to develop a policy that's not theoretical. It has to be one that private sector companies could implement. The private sector companies with whom we work are far from understanding this concept. You know, we work with them all the time. Just having them understand what ecosystem services are in the first place is already a huge step. So what we'd like to do in IFC is write a policy that they can actually implement, a first step. So the first step is that they understand what they are, and the second step is that they attempt to mitigate for their impacts on ecosystem services.
Courtney, did you have a question there?
Actually, this is a question back to Lori, because I do think that our clients as a financial sector are valuing natural capital in many ways, and they're not recognizing it as such. And as an example, as part of the IFC performance standards, a company is required to restore livelihoods for artisanal fisheries, for example. There is a price that is, that comes at a price. So when they're developing a project, they absolutely have to factor in the price of compensation for lost livelihood, and that's lost natural capital.
Yes, you're absolutely right, and it's true. I mean, ecosystem, we're calling it ecosystem services, but social development specialists have been looking at this for the past 20 years, and they call it natural resource-based livelihoods. Then you have cultural anthropologists that look at cultural heritage, and that includes cultural ecosystem services. So this is why we had so much difficulty with the performance standard. We didn't just want to, this is a term that in our world, biodiversity specialists mainly talk about, as if it's a new thing. And it's not a new thing. Some aspects of it are new in the terms of how we deal with it in the performance standards, regulating ecosystem services, for example. It involves more of a sociological, socio portion and an eco portion. So the standard ESIA right now that most companies use really silo these two. They look at environmental impacts and social impacts. That's not how ecosystem services is going to work. So we have to look at, we have to almost find, the challenge here is working with existing methodologies, which most companies use the ESIA. That's what most companies use. And expanding that paradigm or that model to more broadly incorporate an assessment and acknowledge of ecosystem services, not just in terms of, yes, natural resource-based livelihoods, absolutely, cultural heritage, absolutely, but more in terms of, more of these, I think the missing piece is really regulating ecosystem services and tying the eco-social dimensions together in the ESIA.
I think understanding the interconnectedness of these issues is a real challenge. It's one that clearly people are beginning to
even in the
with.
impact assessment, sector, the specialists, this is a huge challenge in itself.
Absolutely.
The environmental, social, cultural, there is no integration, and it's a huge issue.
Absolutely. When you speak to social development specialists, most of them, and this is a terminology that we use in IFC and amongst the banks, but these are the specialists that look at impacts on communities, essentially. When you speak to most social specialists that I know, they don't understand what ecosystem services are. But yet, as Courtney just mentioned, they are doing that. They are looking at livelihoods, livelihood restoration. These are all ecosystem services. So there is a language issue here, and there is a very real need to implement what we're intellectualizing on one hand with field applications for the private sector to implement on a site-specific basis, which is most of the time where private sector lending organizations like IFC is coming in. They're not looking at the landscape and developing where they should be. The site's picked, we have to work there. How do we evaluate impacts?
And it's really worrying that we're having language difficulties around something with a $4 trillion price tag attached to it.
Cost to society, yeah.
Matthew,
trying to figure out what it is.
Kiernan, did you have your hand sort of up? You were just waving. Any last or final questions? Oh, yes, there's one in the middle. Top row. No, we'll wait for the mic if we can. It's great exercise. And is there another question over here? Yes, there's one at the front afterwards. We'll take these two and then we'll wrap up.
Hi, my name is Amy Larkin from Greenpeace. And I wanted to ask, some of these issues are difficult to measure, but some of them are not. For example, deforestation. So given the extreme weather we've been having the past several years, in China with mudslides, in Pakistan with flooding, this week or last week in Thailand with flooding, deforestation has actively exacerbated this extreme weather and caused, Mr. Sukhdev, maybe you can measure the amount of money, huge damage, and the companies that cut down the trees and the companies that use those trees for supply chain, for products all kept their profits while huge, huge, huge disasters ensued. And so I want to ask especially the bankers, if you're talking about future-proofing your bank, at some point, people are going to be able to make that connection, and anyone who depends on trees and cutting down forests is going to have a big sticker shock. You all and financial institutions have basically stopped investment in nuclear power. Do you think something comparable could happen regarding certain kinds of forestry practices?
Excellent. Well, let's take quick responses from the three bankers. When I think of deforestation, I do think of Brazil, Daniela. What's your perspective on this?
If I got the question correctly, but I understood she's asking about the impacts deforestation can have in our supply chain or the end product,
or your financing of corporations that result in deforestation.
Okay, so this is something that, at least for Rabobank, is an old issue. Yeah. That because we are financing a lot of agribusiness around the world, so more than 10 years ago, this issue came up, and we had to face this. And there were also NGOs coming to talk to us, and we sit together and we try to find consensus and the solutions together. So the point for deforestation for Rabobank is something that nowadays we believe we are managing through the roundtables, because we ask for our clients, for instance, palm oil producers or soy producers or cattle ranchers, we ask them if they are not yet, that they should join these roundtables. Okay. Then they will produce under these principles and criteria that are considering the high value areas of each country. Okay. So this is something that we are already aware, and we always try to bring more value for this. So that's the reason we're involved in RED projects in Brazil, especially in Amazon biome, because we want our farmers and other buyers in the chain to keep the trees. So we are trying to bring this process.
Okay, let's have the perspective of one of the Wall Street banks. André?
Sure. Yeah, just very quickly, I think you already do have a number of banks who have developed forestry policies, and there'll be different definitions, whether it's illegal logging they're looking at, whether it's high conservation value forest, primary forest. There's a whole litany of definitions, but the point is that you do already have a number of banks looking quite seriously at this issue. There actually is, in London, towards the end of November, going to be a biodiversity conference, and one of the topics is going to be, and this is a conversation Shawn and I have been having for 8 years now, is there an equator principles for forestry? So do banks start looking more collaboratively over or around the questions of, do we try and compare notes on forestry policies? Do we have consistent approaches? Because it is absolutely a factor that banks are taking into account. I think the challenge we all face is that if you look at who's actually financing forestry globally, it's a lot of the Southeast Asian banks and others who aren't looking at these factors as progressively as some of the Wall Street banks are. And we often have pretty small forestry portfolios. So it does remain a challenge, but it is something we're looking at.
We have a final question here at the front.
Yeah, it's said that the best way to predict the future is to create it. So I'm wondering, why do banks continue to suggest that they are removed from the risks at all? And does the banking system recognize its responsibility to act directly upon the political system, including at the electoral and issue advocacy level, in order to implement the kind of policies that will enable their future profitability in a fair and ecologically balanced manner?
Well, Shawn.
Well, that's a great question, and it's a great way to end the evening. But I think, from my perspective, we've never said that we're not at risk. No. Absolutely, we are at risk on a lot of these issues, and that's why we've come together collectively as institutions, first of all, in this room, to talk about these issues, but also to develop these broader sustainability frameworks, the Equator Principles, carbon principles, where some of us are members of these roundtables. So absolutely, they are risks. They have to be managed We have broader risk policies. It's not just about project finance. So we all understand that these are very serious issues, and they not just threaten our reputations if they're not managed well, but they could impact our bottom line.
And it's interesting, there's a meeting taking place here in Washington on Friday amongst many of the leading banks, and they chose two sectors to look at for potential cooperation, and they were energy and agriculture, because these issues are finally, despite their economic invisibility, coming on to their radar screen, particularly through the supply chain lens that you referred to in your opening words, Daniela. And I think for many businesses, that will be where they will confront ecosystem services. Any final comments from the panel? It's been a great session, and in a moment I'd like you to thank the panelists. We referred to the Natural Capital Declaration, which we are beginning to, we're finalizing the draft, and we're beginning to spread the word. We want to get a coalition of banks signing that declaration in the run-up to Rio. We want to make a very positive statement, and it is in part about how banks engage with policymakers to try and actually solve issues around natural capital, biodiversity, and ecosystems. If anybody's interested to look at the declaration, we have a very simple website, very easy to remember. It's www.naturalcapitaldeclaration.org. Thank you very much for coming today. Thank you, Pavan, for your opening words. Thank you, Laurie, Shawn, André, and Daniela. Clearly, it's the beginning of a journey for many of us, but one quite clearly that we need to sort out pretty quickly. Thank you all for your attention. And it's www.naturalcapitaldeclaration.org. Please go there. Thank you.
If I can just keep you for 1 second for two final housekeeping points. The first one is that we are having dinner tonight at 7:30 at the National Building Museum, and the dress code is business attire. And the second housekeeping point is for tomorrow. Please remember to bring your badges. As you know, we're starting with a special session where we'll be addressed by Gordon Brown, and it will not be possible to enter this premise without the badge. So please do remember that. Thank you, and good evening.